Most money was never printed. It did not roll off a government press. It was not pulled from a vault. It was not sitting in someone else's savings account, waiting for a banker to lend it out. Most modern money begins as a line on a balance sheet. A promise is written down, a debt is created, a deposit appears, and suddenly money exists. This is unseen hand, revealing the hidden forces that shaped money, empires, and your future. Here is the story most people are taught. You put $100 into a bank. The bank keeps $10 in reserve, lends $90 to someone else, then that 90 gets deposited again, and the process repeats. Textbooks call this the money multiplier. It is clean. It is memorable. And for explaining the real modern system, it is mostly the wrong machine. Banks are not warehouses that lend out piles of old money. Banks are balance sheet institutions. They create bank money when they lend. Imagine a borrower walks into a bank and receives a $100,000 loan. The bank does not open a drawer and remove $100,000 from another customer's account. It writes two entries. On the asset side, the bank records a loan. The borrower owes the bank $100,000. On the liability side, the bank records a deposit. The bank now owes the borrower $100,000 on demand. The borrower checks the account and sees spendable money. That is the core mechanism. The loan creates the deposit. The debt creates the money. The ledger creates the thing you call cash in the bank. This is not a conspiracy theory. It is how central banks themselves describe the system. The Bank of England put it plainly. When a bank makes a loan, it simultaneously creates a matching deposit in the borrower's account, thereby creating new money. But this does not mean banks can create infinite money. That is the mistake on the other side. Creation is easy. Settlement is discipline. If the borrower spends that deposit to buy a house, and the seller uses another bank, the first bank may lose reserves when the payment settles. Reserves are the money commercial banks use between themselves. They are not what you and I usually spend. They are the plumbing behind the screen, so the bank can create a deposit, but it cannot ignore the rest of the system. It needs capital, it needs liquidity, it needs credit-worthy borrowers, it needs collateral, it needs to survive regulation, it needs other banks to trust it, and it needs to settle payments when money leaves its own walls. That is why fractional reserve is the wrong focus. The real limit is not a little reserve jar in the basement. The real limit is the balance sheet. A weak bank cannot expand forever. A bank with too little capital hits a wall. A bank with bad loans loses trust. A bank that cannot fund itself in the market becomes dangerous. A bank facing deposit withdrawals must find settlement money fast. Modern banking is not magic. It is controlled accounting under pressure. Now follow the machine one layer deeper. If commercial banks create money through deposits, shadow banking creates money-like promises through collateral. A repo transaction is the simplest doorway into that world. Repo means repurchase agreement. One party gives a security, often a treasury bond, and receives cash. Later, usually the next day, it buys the security back at a slightly higher price. It looks like a sale. Economically, it works like a collateralized loan. Think of it as Wall Street's overnight pawn shop. A dealer brings in a treasury bond. The market hands over cash. Tomorrow, the dealer returns the cash plus interest and gets the bond back. In calm times, repo feels almost like money. It is short-term. It is backed by collateral. It rolls over again and again. Cash investors treat it as a safe place to park funds. Dealers use it to finance securities. Hedge funds use it to build leverage. The same collateral can move through multiple hands. This is where the shadow system creates liquidity, not by printing dollars, by turning collateral into cash-like claims. And then comes the darker mechanism, rehypothecation. A hedge fund gives collateral to a prime broker. The broker may reuse that collateral to borrow from someone else. That lender may reuse collateral again. A treasury security becomes part of a chain. One asset supports multiple promises. It is efficient when everyone trusts the chain. It is terrifying when they do not. Because in a panic, people stop asking, "What is the yield?" They ask, "Who has the collateral? Can I get my cash back?" And what happens if everyone asks at once? That is what made 2008 so dangerous. It was not only a mortgage crisis, it was a run on shadow money. The line outside the bank became a refusal to roll overnight funding. Repo lenders demanded more collateral. Asset-backed commercial paper stopped rolling. Money market funds that looked like cash suddenly looked risky. After Lehman failed, the Reserve Primary Fund broke the buck, meaning shares that were supposed to be worth $1 fell below $1. A money market fund is not a checking account, but investors had treated it like one. When confidence cracked, the illusion of cash cracked with it. This is the hidden architecture of modern money. Bank deposits on one layer, repo and money market funds on another, securities lending and collateral chains underneath, and central banks standing behind the system when private trust fails. But the deepest layer is global. The dollar does not only live in America. Eurodollars are dollar deposits and dollar claims created outside the United States. The name does not mean euros. It means offshore dollars, dollars booked in London, Singapore, the Cayman Islands, or anywhere outside the domestic U.S. banking system. A foreign bank can create a dollar loan. It can create a dollar deposit. It can owe dollars to one institution and be owed dollars by another. These are not Federal Reserve notes sitting in a vault. They are dollar promises written across global balance sheets. The offshore dollar system made the dollar bigger than the United States. But offshore does not mean disconnected. To settle real dollar payments, foreign banks often depend on correspondent accounts with U.S. banks and payment rails that run through New York. The euro-dollar market may be offshore, but the wires often still touch the empire's capital. Then add FX swaps. A European bank with euros needs dollars. It swaps euros for dollars today and promises to reverse the trade later. Economically, it has borrowed dollars. But on the balance sheet, this can look different from a normal loan. The Bank for International Settlements has warned that enormous dollar debts hide inside swaps and forwards. So some of the world's largest dollar obligations do not look like ordinary debt at all. They live in derivative contracts, in repo books, in offshore deposits, in collateral chains, in the spaces between balance sheets. This is why crises always reveal the truth. In calm times, money looks simple. A bank balance, a fund share, a repo claim, a dollar deposit in London, a treasury used as collateral. In panic, the hierarchy appears. Everyone wants the safest form of money. A money market fund wants bank deposits. Banks want reserves. Foreign central banks want dollars. And the world looks to the Federal Reserve. That is what central bank swap lines are. In a crisis, the Fed provides dollars to foreign central banks, which then lend them into their own banking systems. In calm times, the offshore dollar system looks private. In panic, it looks to the Fed. So how do banks really create money? At the first layer, commercial banks create deposits when they make loans. At the second layer, shadow banks create money-like claims by transforming collateral into short-term funding. At the third layer, offshore banks create dollar claims outside the United States. At the fourth layer, derivatives and swaps create hidden dollar funding needs that do not always look like normal debt. And at the top of the hierarchy sits central bank money, reserves, currency, and emergency backstops. The printing press is only the image people understand. The ledger is the machine people live inside. That is why the real question is not, do banks lend out deposits? The real question is, which promises are allowed to become money, who gets to write them, and who gets rescued when the promises fail? Because every monetary system is a hierarchy of trust. At the bottom are ordinary people using deposits as if they are cash. Above them are banks creating deposits as liabilities. Above them are dealers turning collateral into overnight money. Above them are offshore institutions manufacturing dollar claims. And above all of it is the state, deciding which parts of the hierarchy must be saved to keep the whole machine alive. Modern money is not created from nothing. It is created from debt, collateral, confidence, and law. The scary part is not that banks create money. The scary part is that the money can disappear when the confidence behind it disappears. A deposit can be withdrawn. A repo can fail to roll. A money market fund can break the buck. A swap can become impossible to fund. A safe asset can stop being liquid. A balance sheet can shrink. And when enough balance sheets shrink together, the money supply does not need to be destroyed by fire. It vanishes by repayment, default, margin call, and panic. The old myth says, money begins in a vault. The modern truth is darker. Money begins as a promise. And every crisis is the moment the world asks which promises were real. If this gave you a new perspective, hit subscribe. History has the answers. We show you where to look.